Good afternoon. I wanted to provide a quick update to the Federal Reserve's rate cut decision that was posted yesterday. Stay tuned. We're going to dive into that next. Hi, my name is Paul Zachary Shelton Jr. I am the Chief Investment Officer of Warwick Advisors. And if you are looking for any type of help with your finances, wealth management needs, please reach out to us. Subscribe to this channel and like this video for more updates on all things financial. So before I talk about the Fed's decision yesterday, let's define really what the job of the Fed is. So the Federal Reserve is the central bank for the United States, and their primary job and goal is to maintain price stability and full employment, or maximize employment, I should say, within the U.S. economy. Now, there are several factors that must be played into their job role since the United States is such a large and global economic partner in the economic theater. One thing that always has to be looked at is what's going on abroad, what's going on in the European theater, and also what's going on in the Asian Pacific. Those factors play a big role in the Federal Reserve's decisions on monetary policy. So in the most recent meeting that was conducted over the last 2 days, Tuesday and Wednesday, with the decision being levied on Wednesday, Fed Chairman Jerome Powell stated that he feels that the economy, the U.S. economy, is in a great position right now. Some of the key points that Fed Chairman Jerome Powell mentioned in his speech yesterday was that the overall economy is very stable and looks very good and healthy when it comes to the terms of the U.S. economy. We right now have full employment in our economy, as we mentioned before in some of our research that Warwick Advisors produced. Additionally, we do have rising incomes in our economy. We have stable household spending, moderately growing household spending, and all of these factors play well into the overall economic picture of the United States. Some of the negative data points that Fed Chairman Jerome Powell pointed out was business investment and manufacturing has slumped in recent quarters. So that means that corporations are not investing as much in inventory, in spending. Additionally, he noted that some of the conflicts between China and the United States when it comes to the trade war has negatively affected many sectors of the U.S. economy. Additionally, sluggish growth globally also plays a major factor on the Federal Reserve's stance when it comes to monetary policy. So as expected by Wall Street, the Federal Reserve decided to reduce or cut interest rates again. This is the third time that they cut this year. So right now the policy rate stands between 1.5% to 1.75%. The chairman did note that monetary policy is not on a preset course. So they're continue to lean and be data dependent in their monetary movements and their decisions that they make regarding monetary policy, meaning that we're not going to stay in any prolonged route, whether it's cutting interest rates or whether it's increasing interest rates, but yet the Federal Reserve would be cognizant and receptive to the tenor of the business environment within this country and within the entire globe and move in lockstep with that as needed. So where do we feel the economy is heading now that the Fed has cut rates for the third time this year? We don't see that there is really a true need for an overly accommodative monetary policy within this country. We do have a fundamental core when you look at all the economic data that is very strong and supportive of organic growth in the economy without the crutches of monetary policy. However, with monetary policy being accommodative as it is right now, and we're being in a standpoint of supporting the global theater to a certain degree, we do feel that there will be some potential tailwinds from reduced interest rates in the overall economy. And this will be seen in various sectors. It could be seen in the automotive sector, and it could be seen in other areas and other sectors of our economy that rely heavily on debt if they're able to refinance that debt at a much lower rate. As we mentioned before, we do not see our economy going into a recession in the near-term future in the next 2 to 3 quarters, but we do see sluggishness and softness ahead down the road. If you look at some of the other economic indicators that are present, such as business spending, corporate spending, retail sales, and some of the numbers that have to do with real estate, there are some signs of softness in our economy. And as we continue to mature down the road, we'll have to see what happens and how the trade war plays out. If there is continued uncertainty around the trade war, that will only increase volatility in the market. If you have any questions about investing or the current stance of our economic and monetary policy within this country, please reach out to me directly. I love having this conversation, and I would love to speak to you about building a portfolio for you that can stand and weather the economic policy. You can reach us at investments@warwickshore.com. I look forward to speaking with you. Have a great day.